Welcome to the next session in our 2026 Alterna Wealth webinar series. My name is William Evele, Director of Wealth Management here at Alterna, and I want to thank you for the time to join us today. Now, whether you're joining us from home, the office, or somewhere in between, we really appreciate you spending the next hour with us. At Alterna Wealth, we believe that financial confidence is built over time through things like education, thoughtful planning, and having the right conversations at the right moments. So our webinar series is designed with that in mind, and each session focuses on topics that are timely, practical, and directly relevant to financial decisions that Canadians are facing today. Now, the goal is not just to share information, but rather to help you better understand your options and feel more confident about the decisions ahead. Now, one area that consistently raises questions for individuals and families is tax planning. It's an important part of your overall financial picture, yet it's also an area that can feel complex, technical, or easy to put off. So today's webinar is designed to help demystify that process. Over the next hour, we're going to focus on practical tax planning concepts, some useful tools or strategies that can help you prepare not only for the current and upcoming tax season, but also for 2026 and beyond. So the session really today is about building a strong foundation, understanding the basics, recognizing opportunities, and knowing what questions to ask as your financial situation evolves. Before we begin, I just wanted to run over a few quick housekeeping items to help you get the most out of today's session. Today's webinar is being recorded, and you will receive a follow-up email with the recording link and a short survey. Please feel free to submit questions at any point using the Q&A function at the bottom of your screen, and we'll make time towards the end of the session to try and address as many questions as we can. We're together for 1 hour, and we encourage you, of course, to stay with us right through to the end. Now, I'm very pleased to be joined today by Doug Carroll, who many of you may already know from previous Alterna Wealth webinars. Doug is a tax and estate specialist with Aviso Wealth, where he supports advisors and clients across the country on tax and estate planning matters affecting individuals, families, and small businesses. And in his role, Doug closely monitors things like legislation, case law, public finance departments, and really just takes all this information and translate that info into a clear, practical guidance for you. Now, what sets Doug apart is his ability to take complex tax concepts and explain them in a way that's approachable and relevant and actionable, really helping people understand not just the rules, but how those rules may apply to their own circumstances. So we're really fortunate to have his expertise with us today. Doug, I'm going to turn it over to you, and I'll pop back on here at the end, or perhaps throughout if there's any questions that come through. Over to you.
Okay, great. And I am going to push up my my screen here, my slides. Oh, sorry, I have to change the way I pushed it up, and then I closed it down. So
No problem.
I have to move it over, and then I'm going to push it up here, and we'll get started with things here. Okay. So
Looks good.
as long as you can see it, then everyone else can see it. Thanks, William, for the introduction, and thanks everyone for joining in on the session here today. I do appreciate, particularly in the comments that you made, the comment about planning for the upcoming tax season and the year and the future years ahead. A lot of what people think of in terms of tax planning is associated with the filing of taxes, which is due by the end of April at the latest. But really, that's about previous year's compliance requirement for reporting, whereas what we want to do is both do that as well as look forward into the coming year and the years ahead and how we might position ourselves in a way that we manage our taxes as much as possible. Now, I'm just going to throw up there the points that I'm going to get into, the slides that I'm going to get into here, so you can see that as I'm giving you a little bit of the overview here. I'll take you through these 10 topics, and if something really critical comes up that you have in mind that you want to pose, and William agrees, then maybe he'll flag me down and say, "Oh, hang on a second, let's go deeper on this," or "You didn't quite explain that so that everybody got it, so we'll go back to it." But otherwise, chances are that as I'm going through this, there is a connection from topic to topic, and I'll cover off the high level things, and we'll leave the questions mostly towards the end. So I'll leave it at that for now, and start you through talking about this. And as the first start to the whole thing, talking about our income tax system specifically, I want to give you the key components that are involved in the income tax system. And in our world, in Canada here, we have a federated structure, meaning that we have both a national government and taxes paid to that level of government, as well as to our respective province or territory. And so the federated aspect of it is that we have both of those that we pay taxes to, and that in both cases, the tax rates are what are referred to as progressive brackets. Sometimes you'll hear the term of marginal brackets or graduated brackets. And basically, the idea is that you pay higher rates of income for you pay higher rates of tax on higher rates of income. And the idea of it is that those who are more capable can then pay their fair share. And in saying that, I think that it is important to understand that the taxes are, when well managed, they are what supports our society that we have. If you don't like the way that the tax system is set up, if you don't like anything on a public policy basis, then you can take political action, you can vote, and perhaps you can run for office. But in terms of what you can do on the personal level to manage your taxes as effectively as possible, most of it has to do with being aware of how the income that you receive is taxed, and then doing your job, reporting on time so you don't face any penalties that might arise if you do it incorrectly or if you do it not on time. Complex tax planning is more likely something that you're going to see with business operations, where there be more decisions that are made in that case. There might be borrowing involved in the economic structure of a business, whereas on the individual level, most of the tax planning that most of us will do is coordination in the household, coordinating with the other person if there's a couple that is involved, to coordinate the income that they are receiving on a current year basis, looking forward to what they're going to do in their later years, and how retirement income can be structured in such a way that there is more to be used in the household because it is shared with the two taxpayers that might be involved. So that's mainly where we're going to spend our time here. In terms of the structure of the system, then, on top of the fact that we have this progressive tax system, we also have some ways that are built in to reduce the taxes that we pay. And the two ways that can happen is commonly to have tax credits and tax deductions. Now, tax credits first. Tax credits are a reduction of taxes that you pay once you've calculated how much you otherwise would owe. So again, you work your way up through, based on your income level, pushing up through brackets. The provincial and the federal government later on, though there are two almost leapfrogging one another, their brackets that you face, that determines what your initial tax obligation is. And then tax credits, based on the obligation that you have, the amount that you owe, reduce down how much tax you pay. In past years, the way that I would express this is to say that tax credits are mostly at the lowest tax bracket. And when I say mostly, there are a couple of credits where you get a very high level of tax credit. The charitable tax credit and the political contributions credit both give you a much higher credit rate. But otherwise, there is a low rate that applies, and the low rate is, or has been, the lowest tax bracket rate, which for many years, almost decades now, I guess, has been 15%. If you think back to last year and what happened last year in the election, the proposal, which then was implemented, was a reduction in the lowest bracket rate from 15 to 14%. And that, after the election happened, the Liberals went ahead to implement that as of July the 1st. So we had a 15% lowest bracket rate for half of the year, 14 for the remainder. So for last year on its own, you will be facing a 14.5% combined rate on the lowest bracket rate of income. The 14% rate then will be the rate that will apply from this year forward for 2026 forward. The unfortunate part of that, if you will, is that tax credits are defined in the Income Tax Act to be at the lowest bracket rate, which means that though you will have a reduction in your initial calculation of your taxes federally, going from 15 to 14%, tax credits that you'll be entitled to also are worth proportionately just a little bit less. They're not going to be based on a 15% calculation, but on a 14% calculation. And so later on in the year, if you recall what happened, or if you don't, it doesn't really matter whether you recall or not. Later on in the year, there was a budget that was introduced in November where the government then brought in what they called the top-up tax credit. In some cases, you would have people who claim a lot of tax credits, and because the tax credits are not worth as much, then the fact that they reduced lowest bracket down by a point, they lost tax credits, which otherwise would reduce their total taxes, and they may in fact be slightly worse off or not much better off. So for the next 5 years, for 2025 through to 2030, I guess technically that's 6 years inclusively, the tax credit rate will remain 15%, despite that the lowest bracket will be 14% for the initial tax calculation. And then apart from tax credits, we also have the potential for tax deductions. And deductions are more valuable. They're more cash valuable to us because whereas tax credits, despite my explanation of it there, are generally at the lowest bracket rate, tax deductions reduce down your taxable income from the top end. So again, remembering that as you go up higher levels of income, you pay higher rates of tax. If you have a reduction in your income that is subject to tax, it's up here at your marginal tax bracket, and so it brings it down a bit depending on how much of a deduction you are entitled to take. So it's based on whatever your highest attainment of brackets are. So we prefer deductions for the most part to in preference to tax credits. They're worth more then because of the marginal tax bracket treatment that otherwise would apply to the amount which you then are able to deduct. So those are the two ways that we tend to have to operate our tax system. And then backing it up just a little bit from that, overall, when we talk about tax planning, as I mentioned, when you have businesses, then they might get involved in very complicated, complex kind of tax planning. And individuals, you and I personally, may not get into that same level of complexity, but the principles behind the tax planning, the pillars of tax planning, are these four types of effects that you can have. If you're focused strictly on minimizing taxes, if that is your entire goal, then, as is often stated, the best way to have no tax is to have no income. You would rather have income of whatever size and whatever amount and have taxes applied to it than not to have income at all. So it's not a matter of not having taxes and having as low taxes as possible, but it is managing yourself in such a way that you have decent income and then reducing down the taxes that otherwise would apply to that income if you weren't conscious of the way that the tax system operates. So these four principles apply. Deferring off taxation. So better to pay tax at some future point in time because of the time value of money to pay those taxes. You'd rather pay them with future dollars than present dollars. Tax sheltering is that when you earn income, if it is sheltered, then it's not going to be taxed on a current year. Again, it combines with that deferral. It'll be taxed at some later point in time. And in some cases, you might have sheltering which never gets taxed, like a tax-free savings account where you have tax sheltering within the plan and then drawing out of the plan is non-taxable. We also have preferred taxation that can apply depending on the nature of the income that you're earning. In a non-registered account, so not in an RRSP or a TFSA, other tax sheltered accounts like that, if you earn Canadian dividends or you have capital gains, they are taxed in a preferred way as compared to regular income like interest. And I'll give you the rates in just a moment so you can see the side by side, both across the country at highest bracket as well as here in Ontario. The last one here is that you can split income, or if you can split income, then you could reduce down the taxes associated with the income, assuming that it ends up in the same household. So the first three, deferral, sheltering, and preferred income, all relate to the income itself, and the splitting is about the taxpayer involved. So as an example of that, where you have an RRSP, when you make an initial contribution into the RRSP, you get a tax deduction. So that gives you a deferral. Otherwise, taxable income in that year will be taxed at some future year when you draw the money out of the RRSP. And then inside the RRSP, the growth in value, any income that you have or increase in the value is not taxed as it happens. Again, it's deferred until the point where it's drawn out. So you get the sheltering working for you there. When you take the money out, to a small extent, the first $2,000 that you take out of a retirement savings plan, and generally that's after you hit age 65 when you draw it out in the former registered retirement income fund, the first $2,000 is entitled to the pension tax credit, which then drops your tax rate by, again, the lowest bracket rate that I was describing earlier. So you're not facing as much tax on that first bit of money. That pension credit has not been adjusted for quite a number of years or even decades itself. So maybe that'll get some revisiting at some point in time. And the last one is that if you set up a spousal RSP in anticipation that your spouse will be at a lower tax bracket when the money is drawn out, then you're splitting with that person. You also have the possibility, even if the money has been housed in your own RSP, that when you get into your later years and you're taking that as retirement income, you can make use of the pension income splitting rules, which again, split with your spouse. I'll talk a little bit further about that later on. So as I said, I wanted to show you the provinces. This is all the provinces across the country and the different types of income that you might receive. If you look at, well, roughly in the middle, just in the middle portion with the lines underneath it, you see Ontario, the top tax bracket, and I've rounded these into integer percentages, because I don't think that we really need to get into the decimal points here to give a general impression of what's happening. Where you have regular income, and that would be your employment income, it would be interest income that you have in your accounts, your credit union account, banking account. Those amounts are treated as regular income, so they're fully taxable. So there's the top rate you see, 54. It's actually about just over 53.5%. Capital gains is taxable at half, and then again, as the figures are side by side, and I've rounded them, they don't look like half in all cases, but they are. It's just rounding out to integers. And then we have the two types of dividends that I'm showing there, what are called eligible and ineligible dividends. Both of those dividends, those are dividends paid from stock that you own, or where you own that within a mutual fund that holds on to stock of a business, and dividends are paid through it and on to you. Those are Canadian dividends that we're distinguishing between eligible and ineligible. The phrasing eligible refers to when you are receiving income that the corporation has paid to Canada at the top corporate rate, as the Canadian government, or the combination of Ottawa and the province, collect up their revenue from the corporation. The corporate rate is charged, and then because the government has already collected some revenue from that source, you, on receiving that dividend from a Canadian corporation, get the benefit of a reduction in your own taxes, so that the total revenue to the government is the combination of the corporation paying some tax and you paying some tax. The ineligible that you see as the furthest right-hand side is likewise a Canadian corporation that is paying dividends to you as the shareholder, except that in this case, this is usually going to be your own corporation. You run your own business, and is a small business that gets what's called the small business rate. The small business rate is lower than the general corporate rate. So when the money then comes out of that corporation, over which you, as your own business that you own, have some control of when and how much will come out, because the corporation there has paid a lower corporate tax rate, then the combination between that and your responsibility over to pay taxes, your part is larger, having had the corporation pay at a lower rate. Now, Looking at Ontario specifically, you can see all the brackets here that combine the federal and provincial brackets. And you can see we have, I think it comes out to 12, might be 13 now. I should draw some lines in there so we can see exactly where those ends occur. Basically here, same columns that we're looking at, except that now we're going up through brackets. And you can see the rate of income or the rate of tax that is being applied on the next level of income as you go up through thresholds. And to be clear, you pay that rate on the higher income from that point up to the next bracket level. It does not mean that once you break through, for example, 107,785, that you used to pay 31%, and now all of the income up to that point is subject to 34. You pay the lower rates up until that point, and then from that threshold up to the next, then you pay the next higher rate. So that gives you an idea where top bracket rate is just over $250,000. That bottom line that you see there is the same one that I was showing you before in comparison to all the provinces. And now I just want to give you a sense of what I mean when I talk about managing things through a household to try to reduce down the taxes that the household pays overall by doing some income splitting. When you hear the term income splitting, it doesn't sound like in itself it's a great benefit. Almost sounds like you're giving something away. But when we talk about income splitting, we're talking about tax splitting. And because we have income otherwise subject in our tax system, our income tax system, subject to progressive tax bracket rates, if you can split income between people, and again, commonly we're talking about spouses where we do this kind of thing, much, much, much less likely that you're going to be able to do that with other family members like your children, especially when you're talking about minor children. So we'll just stick with the spouses here. As you work your way up through brackets, as I say, you pay higher rates of tax on the next level. And all that I've done here is I've collapsed that first, the second column over, pushed it over a little bit to the left and given it a different name. Instead of calling it regular income, I'm referring to that as the marginal rate that applies on that regular income if you were to receive that income. And then I'm comparing that to the average tax rate. And the average tax rate is quite simply taking the income up to a particular level and the taxes that have been paid up to that level, dividing the taxes by the income. So where you see that, I'll take the same place where I had it before at the 107,000. Just over $19,000 of taxes paid divided by, I picked the wrong line, 23,000, just about 23,000 divided by 107,000 gives you approximately 22% as your average tax rate. And why I want to highlight the difference between marginal tax and average tax is that if you have two people in a household who are earning income, then you can reduce taxes if you have both of them earning income rather than a single person earning income. So, and I'm not going to go into, well, how are the many ways that you can do this, but you just want to be able to see the difference between one person earning income and going up through continuing brackets versus two people going up through a few lower brackets. So if we had one person in a household earning 100 grand, then the net for that person would be 79,000. But if you had two people who did not go up into those higher brackets between 50 and 100,000, if you had two people who had $50,000 of income, then you would reduce the tax for the household by $7,000 and so dollars. So that's what we're talking about when we're talking about income splitting. And much of this, again, this is really just cherry picking so that I can give you an example, but much of it is done between spouses by setting things up in such a way that later retirement income is then available and flexible enough to be split between the two of them rather than being significantly or entirely in one person's hands. And as I mentioned, there are a couple of built-in mechanisms that allow for that to happen. We'll get into some of the other ways that you can do some income splitting shortly. So on the front end of things, when you're making RSP contributions, RSP being registered retirement savings plans, You are entitled to make contributions into an RRSP because you have earned income, which for the most part is employment income that you have earned. The calculation for how much room you are entitled to make use of, so how much of an envelope you have to put money into an RSP, is 18% of the previous year's earned income, which again, for practical purposes, we'll refer to that, or we'll think of that as being employment income. There is a legislated maximum that applies to that. So if you were making $1 million, it doesn't mean that you could put $180,000 into an RSP. The legislated maximum, which indexes from year to year, is currently in 2026, 33,810 that you see here. And that figure is reached down below. You can see on the asterisk, it's reached at $187,833. So if you have income up to that level, or that level and beyond, the most that you earn as a room to put into RSP is that 33,810 amount that you see there. So anything else that you have less than that 187,000, you'll get 18%. So simplest example I can use, if you had $100,000 in earned income, then you would be entitled to 18,000 of room to put into RSP. And when you calculate your RSP room, if you don't use it in a particular year, then you can carry it forward to use in future years. So the room that you have available, you can either put it into your own RSP, or you can put it into your spouse's RSP, and we refer to as a spousal RSP. You, as the person who has the earned room, get the tax break on the contribution, whichever side you might put it into. And the idea with the spousal RSP is that you're setting it up, you're anticipating what your relative income levels will be out in the future, and the asset holdings that you have that then will be drawn down to be taken in as income, so that you are setting up so that your spouse will be able to draw down some of those assets, him or herself, rather than for you to be doing that. And that will then allow for that person to be taxed on those amounts. Now, if you put money into a spousal RSP, so I'm going to talk to you as the higher income person. If you put money into a spousal RSP in anticipation that your spouse, as a lower income person, whether they're low income now, or more importantly, low income out at the point that you expect them to draw the money out, you are doing that so that you can facilitate this kind of income splitting. But in order for people not to be using this as a year-to-year type of tax planning strategy, the tax rules will cause withdrawals that are taken in the first 3 years. So that's the year of contribution plus the next 2 calendar years, to be attributed back to the contributor spouse. So be careful about that. If you are nearing the point where you're going into your retirement years and you make contributions into spousal RSP, you might be caught by that if the withdrawal has happened in that near-term time frame. One of the concessions to that is that when money is taken out of that plan that goes into a RIF payment to the spouse who owns the spousal RSP, the minimum required amount that comes out of that, because RIFs are the back end of RSPs. RSPs, you have an amount that can go in. There's a limit on how much can go in, and then with the RIF, there is a minimum that must come out each year based on your age. So that minimum that comes out on the RIF is not subject to the attribution, but if you take amounts above that, then you could have the attribution back to the contributor person. And again, assuming that the contributor is at a higher tax bracket than the person who is the annuitant on the RSP or the owner of the RSP, then the tax plan that you thought you were going to be doing is going to be somewhat, if not entirely, undone if you overdo it with those early withdrawals from spousal RSP. Now, you can put money into RSP with that carry forward. You can make contributions into your RSP up until the end of the year that you turn 71. After that, you can't put any more money into your RSP. And I say your RSP because If you have a spouse who is under age 71, then you can make contributions into your spouse's RSP up until the end of the year that that person turns 71 or has turned 71. And that includes actually that you can earn RSP room after the age of 71 because you have earned income, and you can then use that to go into your spouse's RSP. So 71 is an important age both for yourself and for the coordination that you have with your spouse. The other thing that you can do is that, as I mentioned, with a RIF, there is a mandatory minimum amount that must come out of the RIF, and I'm not going to confuse things by throwing percentages at you, but it is based on a person's age, and the older you are, the larger the percentage that has to be drawn out of the RIF. When it comes time to draw the money out of your RIF, then you can either do it based on your age or you can do it based on your spouse's age. And if your spouse is younger, then there will be a lower required percentage that will be drawn out of the RIF on that basis if you make that election to use your spouse's age. Now, a few other ways that you can look at managing between spouses. We have tax-free savings accounts. So as compared to an RSP, RSPs do allow you to take a deduction when you put money into an RSP, which is another way of saying that you're putting in pre-tax money into the RSP. Whereas with a tax-free savings account, when you're putting money into it, you are putting in after-tax money. You don't get a tax deduction on putting the money into a tax-free savings account, but then the tax sheltering inside, likewise with RSPs and RIFs, you get tax sheltering on the growth, but on the TFSA, when you take withdrawals, there is no tax on the withdrawals, whereas the RSP and the eventual withdrawal through a RIF, or if you don't do a RIF, then Registered Retirement Income Fund, you could also transfer the money over into a registered annuity that you purchase from an insurance company. And if you do it that way, again, the amounts coming out of either the registered annuity or the RIF are taxable. Whereas with a tax-free savings account, no tax on the amounts coming out. You don't have the capability to make a direct contribution into, quote, a spousal TFSA. So there is no such thing as a spousal TFSA, but you can just give money if you've got the cash and your spouse has room to make use of the TFSA, which obviously is going to be to your mutual benefit to make use of that tax sheltering room. You can give money to your spouse and it can go into the spouse's TFSA. You still get the tax sheltering, and then withdrawals that are made from the TFSA come to your spouse and are not taxable to either of you at that point. You also have the possibility, and I mentioned this earlier about making use of the pension income splitting rules. The way that this operates is for your own eligible pension income, which is a definition that includes registered pension plan money, if you're a member of a registered pension plan, as well as draws from a registered retirement income fund or a registered annuity. So those amounts that you are entitled to, you'll receive those during the course of any given year once those start paying out to you. And then when it comes around to tax filing time, you and your spouse have the ability to elect up to 50%, 50, of what you receive to be then taxed over to your spouse. If it's a registered pension plan, then you can do this under the age of 65. But for RIFs and registered annuities, you have to be over 65 to fit the definition of eligible pension income. Importantly here, a registered retirement savings plan. So in that form, that accumulating vehicle of an RSP, you don't get the benefit of the eligible pension income or the pension income splitting rules. With that, you have to take the RSP money and transfer it over into, again, either a RIF or a registered annuity and draw the money out of that kind of a decumulating structure in order to get the benefit of the pension income splitting. And then In distinction to the pension income splitting rules, we also have the ability on a one-time basis. So the pension income splitting is an election that spouses can do on an annual basis, and they can do different percentages. It can be up to 50%, but it can be anything from 1 to 50%. Whereas the Canada Pension Plan credit sharing rules is a one-time transaction between spouses where the two of you, having accumulated your entitlements, contributing into the Canada Pension Plan, the premiums that you paid during the course of your working years, you have credits available to you. It's an insurance-based program where you make contributions into the plan, mandatory. And then when you get out to the point when you can start your CPP retirement pension, which can be as early as 60, it can be late as late as age 70. 65 is commonly referred to as the normal retirement age. If you take it earlier, then you take a reduction in what you're entitled to for life. And if you wait until any time after 65, you get a premium or an upgrade all the way out to age 70, again, for the payments for life. Once you are looking at the point where both spouses are at least age 60, you can take your credits that you've accumulated during the time that your spouses, mind you, if you're together for a relatively short period of time, it's only the credits that are generated during the time of the relationship. But let's say that these are childhood sweethearts, and spouse two is the one that has more income that has been paid into the Canada Pension Plan. You would otherwise have in the proportions here, spouse two getting 6 percentage wise or in ratio, 6 credits worth of pension income versus 2 for spouse one. In this case, with the CPP credit sharing, both of you contribute your entitlements into the common pool for the time that you've been together, and you take half back out again. So whereas with the pension income splittings rules, it was a one-way transaction where the person who was entitled to the pension income would then have their income on election between the two of them go in the other direction, up to 50% being taxed over to the other spouse. With the CPP rules, both contributed all their credits for the time period they've been together and then take back out half, which again, just on the basis of pension income splitting and just income splitting generally, because we've got graduated tax brackets, the likelihood then is that we will reduce down the tax bill for the household together by having things levelize, equalize to some extent of this source of income from the Canada Pension Plan. Now, there are a variety of other ways that you can split income between spouses. You can manage things so that you reduce down the total tax between the two of them. If you, in the simplest of efforts you might make, if you just give money to your spouse and your spouse invests that, you might hope and expect that, in fact, the lower income spouse who is the receiver of that, if that's your strategy, the lower income spouse will be taxed on that investment income. Unfortunately, it's not that simple. A gift to a spouse that is used to generate investment income causes that investment income to attribute it back to the giver spouse, to the original source. But you can structure the arrangement between the two of them if it is something you want to pursue. You can structure it instead as a loan between the spouses. And in that way, the higher income spouse who has assets available will loan the decided amount over to the lower income spouse. Interest must be charged, which the lower income spouse then has to pay the higher income spouse. That will be an interest deduction to the lower income spouse and an interest inclusion, income, to the higher income spouse. And then the investment income is taxed to the lower income spouse. So that works around in a legitimate way, works around the potential attribution of all of the investment income back to the higher income spouse. The rate that has to be charged on that is dependent upon the state of the economy. The interest rate is based on bond yields in the economy. It goes up and down. It's reset every quarter. For quite a long time, between about 2009 and 2021, 22, it was 1%. And so interest being charged to on that basis, a 1% inclusion to the high income spouse meant that in a likelihood, this made good sense where you had two people who were at distinctively high and low income levels that you could set one of these things up. Currently, the prescribed rate is at 3% for this quarter, for the first quarter of 2026. Whether that works for you, it's a good conversation to have both with your tax advisor and with your financial advisor to see whether that makes sense for you to set up something like that. Another few ways that you can get around these income attribution rules would be to set up an arrangement where, despite there being an apparent gift from high income spouse to low income spouse, the low income spouse, if that money is put to work in an active business, or the low income spouse gives something of fair market value, like $10,000 cash coming in one direction, $10,000 worth of a car going another direction, then there won't be attribution. And then also what's called second generation income or income on income, that's not attributed. So when the first year of investment happens and you have income, if you can pull out the income as it's earned, despite that it got taxed to the higher income spouse, and reinvest the income in a separate place, then there's no attribution on that amount. Over the longer term, that may in fact allow for a shuffle of money from one to the other in a legitimate way. Where you have gifts or inheritances that are received by the low-income spouse, it's a good idea to isolate those and have those investments so that it's clear that that belongs to the low-income spouse. And so all the investment income, don't commingle it with other assets, but all the investment income then be attached to the lower-income spouse. In terms of doing things that will facilitate more investment or investment dollars for the low income spouse, if the high income spouse pays the household expenses, including paying any interest charges that either of them have to pay, as well as taxes that are due from either of them, then it frees up more money for the low income spouse to be able to invest and then be taxable on that at the low income tax rates. Another thing that's a fairly small but a beneficial thing to think about is where you have charitable giving. Canada Revenue Agency allows for the two spouses to combine their donations so that they more quickly get up into the higher tax credit rates. The first $200 you get low bracket rate, and then thereafter you get a higher credit rate. So if you combine the two, then you can break through that 200 level and be getting the benefits at the higher level after that. Where you have kids, again, fairly limited that you can do tax planning with your kids, but where you have kids, if there is child benefits, particularly the government payment, the Canada Child Benefit, if you can isolate that, if you don't need it for raising the child, which is really what it's for, is to assist families, but if it's not entirely needed, you could set it aside and invest it in an account which belongs to the child. And clearly, if it was paid through the Canada Child Benefit, it never belonged to you, because if it belonged to you, then the child would perhaps earn the income, but it would be attributed back to you as the parent or grandparent who gives to a minor child. Likewise, you have an attribution concern. So you can isolate those amounts. Another thing that is built in as in the system is RESPs, the Registered Education Savings Plans, that have all sorts of their own benefits associated with them. Built into them, though, is the fact that when you make contributions into the plan, it gets tax sheltered it gets government money that supports it, matching grants, and it gets tax sheltering inside the plan. But then when the money is drawn out of the plan, the government money and the tax sheltered income, if it's drawn out when the child is a student, it is payable to the student and is taxable to that student, who in all likelihood is low to no taxes to be paid. And so you've done a little bit of income splitting there by making use of RESPs. Now, with the attribution of income generated by a child, one of the ways, or one of the the types of income that is not subject to attribution is where there is capital gains. So interest and dividend payments are attributable back to a parent or a grandparent if they're the source of the money that's being invested, but not capital gains, which might again inform how it is that you go about investing that money. And the last thing I'll say on children here, minor children, people do sometimes set up in trust accounts, named in trust accounts through financial institutions. It's gone on for decades that it's been available. Don't be thrown by the name, expecting that because you put the name in trust on an account, that is a true trust. It's likely that is an earmarked amount, which is for that child. But as far as the Canada Revenue Agency is concerned, you need to prove to them that you've actually set up a trust for that purpose in order for it to belong to the child, as opposed to the person, usually the parent, who sets that account up. So just couch your expectations of how that might operate. Where you have children who are older, adult children, then you don't have attribution applied to them. If you set things up, though, where you give them low interest loans that are below that prescribed rate that I was talking about, where you do spouse to spouse loans, if you set up a loan between you and you charge less than that prescribed rate, then you may get yourself into a position where an otherwise gift to that child will be clear of attribution, now again becomes subject to attribution because you use low interest rates. So be conscious of using the prescribed rate as a minimum. You can also pay money to a child, an adult child, if you've got younger children, who then would be babysitting. Legitimately, you could do something like that. And that then becomes a deduction to the lower income spouse of the two of you in order to facilitate work. It also is income to that child, which helps them not only receive that income from you and taxable to them, but depending on their income level, there may not be any tax to be paid. And they also have RSP room that they generate from that because it's earned income. Apart from those approaches, you might also look at getting them started because, as I say by the title here, 18 and overs, getting them started on the plans that they are entitled to make use of. Tax-free savings account become available to a person once they reach the age of 18. You have to be a Canadian resident, and then you get the TFSA room on a year-to-year basis. Current year, it's $7,000 of room. First home savings account introduced a couple years ago. FHSAs, again, once you're 18, you can put money into an FHSA. The yearly room is $8,000 on the FHSA with a lifetime maximum of $40,000. So in your household, if you've got children in that position, then maybe you want to help them out to get those things going. The last topic that I'll touch on fairly briefly here is estate planning. Between spouses, one of the benefits that we have is that tax sheltered accumulation that happens in RSPs and RIFs, so retirement savings plans, they can roll over and continue to be tax sheltered upon a person's death if the money goes over to a spouse. With tax-free savings account, you also have the rollover of amounts that are in the TFSA that go over to, if you set up either as a successor, which means the contract continues and the spouse steps into the shoes of the original, or as a beneficiary designation where it pays out to the other spouse. In both cases, it adds to the tax-free savings account room of the person who receives that, and it doesn't affect their own room. So I wouldn't say it doubles up, but it increases the availability of the TFSA. Be aware, though, that unused TFSA room does not roll over to a surviving spouse. It dies with the person who has that unused room at the point of their death. Another consideration, and it's a topic unto itself, is life insurance. The core purpose of life insurance is as an income replacement vehicle. If unfortunately someone dies being a contributor to a household, it stands in and is a proxy for that person money-wise to then support the household. In more advanced applications, you could be looking at contributing even more money into the insurance policy than what the contract requires you. It depends on how the contract is set up. And that excess money, subject to limits, is tax sheltered while in the plan, and then it pays out on a tax-free basis. So it's something worth looking into with your financial advisor. Last thing here, and this is somewhere that people tend to get stuck on the idea, hey, I want to avoid probate. Probate is a small tax, 1.5% at its maximum, that applies when an executor is named in a will and needs to have the courts confirm that the will, in fact, is the will that is valid. At 1.5%, it's just not worth being the driving force in your tax planning. It certainly is something that you want to be conscious of, that you don't trigger any more of it than is necessary, but don't let it be the decision maker about how you manage your estate and how you decide your financial matters. Make sure that everything else is aligned, that it works properly, and then look to avoid probate tax. Conversation more so with your lawyer than your financial advisor, but I'm sure your advisor can give you some guidance on that to start the conversation. William, I am going to let you step back in here and see what's come up in questions while I've been going on through these topics. So I'll let you step in.
Sounds good. Appreciate that overview and going through 10 really important things in 50 minutes. There's lots of information to digest, and we've got a number of questions that have come in. I've done my best to try and summarize some of the themes that I've read through the questions, and I've prepared a few for you that I can put forward now. So the first one is just general comments. When people experience major financial events like buying or selling a home, receiving a lump sum payout from a layoff, retiring, what would be the tax considerations that you would say have the biggest long-term impact, and what should be planned before those events happen?
Well, if you are receiving an amount, one of the common things that comes up is a possible way to get a deduction when you receive an amount which otherwise is taxable. So we're going to assume that this is a taxable amount you're receiving from whatever the event might be. One of the suggestions that comes up is potentially you might make a contribution into your RRSP, because a contribution in an RRSP is a deduction, and so it would counter some amount that otherwise is brought into income. If the amount that you're receiving, for whatever reason, is not a taxable amount, if it is an after-tax figure that is being paid to you, then if you have other income, then making an RRSP contribution might be helpful to you since you have new cash available. But be aware you are putting that into then RRSP, which eventually is going to be taxable. And yes, you'll get the deduction from it. Just be careful not to overdo it. I've seen more than one case, had this in law practice one time, where someone thought, oh, great idea, I got an inheritance. After tax, the person got the inheritance. What it won't make any sense because it's about 25 years ago, but the person was at I wouldn't even use the dollar figure. They were at a very low income level, and based on their income as it was, they made a contribution equal to their income level, which did not make sense because the tax break that they got was was lower than what the eventual tax will be on drawing that money out. So before you jump in and say, I've got an answer for all purposes, have a conversation with your financial advisor and your tax advisor, what you might be contemplating or what they might suggest directly based on your circumstances before you take any action.
We've had many questions from retirees and near retirees about RSPs and pensions, but specifically on whether you can still contribute to an RSP without earned income, and maybe talk about how unused room works in that situation.
Yeah, and you'd have to have well, if you have carry forward of past unused room, then you could still contribute into an RSP for yourself if you're under 71 up until the December 31st of the year that you turn 71, or to your spouse. But if you don't have earned income, then you don't get any new RSP room resulting from that. One of the unfortunate things about it's not entirely new, but one of the unfortunate things about the world as we have it and scammers is you hear all sorts of possibilities of how you can do things because the tax man, I hate that term, the tax man's going to get you. And so let's try and figure out ways that you can get around the taxes. And it's great. You're going to miss out on the taxes because somebody is going to slip the money out from underneath underneath you. So be very careful with promotions that allow for you to supposedly avoid taxes in ways that other people supposedly didn't know about, that may in fact be just scammers trying to fool you into turning over your money to them.
Okay, thank you for that. Just a couple more here before we wrap up. I think these should be easy ones. Is it possible to have both an individual RSP and a spousal RSP?
Yes.
Okay,
Yep.
easy one.
Restriction on that. Yep.
Can you please clarify, can I share my RIF with my spouse in terms of income splitting?
You can. So it's your RIF. You get the income from it under the rules of how it pays out to you. But then when you file your taxes for the next year, so based on 2025, when you file your taxes coming up in the next couple of months, the two of you can then make a decision, you having received that RIF income, what proportion of that might work to your mutual benefit to push up to 50% of the taxation on that over to your spouse. So you're entitled to the rights of the money as you received it last year, but it's who pays the tax, and you'll do that if it's going to reduce down your common tax bill between the two of you. And your tax filer, the person, or the tax software will generally give you some kind of a suggestion of what might work best for you and the reason why it would work for you.
That's great. Thank you for that. And that brings us almost to time. So Doug, thank you so much again for a very informative and practical session. Your ability to break down these tax planning concepts and really focus on what matters for individuals, families, and business owners is really valuable. And I know our attendees today will be walking away with clearer ideas and next steps as they prepare for the years ahead. And this, of course, this tax planning season. So Doug, thank you again. I'll let you drop off because I've got some things to wrap up from housekeeping items, but on behalf of everybody and on behalf of Alterna Wealth, thank you. And thank you everybody for joining. Thank you, Doug. Okay, so for those that are still on the line here, I just wanted to reinforce that one of the key takeaways from today's discussion is that effective tax planning isn't about reacting at tax time. It's about being proactive and understanding your options and really making informed decisions throughout the year. So sessions like today are really meant to give you a strong foundation, but everyone's situation is, of course, unique. So the real value comes from connecting these ideas to your own goals, timelines, and priorities. So if today's webinar raised questions that weren't answered, highlighted opportunities, or prompted you to think differently about your own tax planning, of course, we encourage you to take the next step and connect with one of our licensed Alterna Wealth advisors. So they can really help you review how these tax planning strategies fit into your broader financial picture, whether that's retirement planning, investment strategy, estate considerations, or of course, preparing for the upcoming tax season. Now, in a moment, I'm going to share a slide on your screen that has 2 QR codes. They're these little squares. This is the easiest way for you to take the next step. So I'll give everyone a moment to grab their phone right now. And once you have your phone and I share my slide, simply open up your phone's camera and you point it at the QR code, that little square, and a link will pop up automatically. The QR code on the left-hand side of your screen is going to take you to a page where you can book a meeting with an Alterna Wealth advisor at a time that works best for you. And the QR code on the right is going to allow you to register for our March webinar, which will continue this year's education series. Now, there's no need to download anything. You just aim your camera at the code, and then you tap the link that appears, and we'll leave this slide up for a few moments so that everybody has time to scan. And of course, as a reminder, today's session was recorded. You'll get a follow-up email with the recording link along with a short survey. So on behalf of everyone at Alterna Wealth, thank you again for spending your time with us today. We appreciate your engagement and your trust, and enjoy the rest of your afternoon. And we look forward to connecting with you again soon. So pull out your phones and please scan the QR codes here. Thank you so much.